Good morning. It's October 8th, Friday, 5:49 a.m. Welcome to episode 20. Good morning to you, Wowie.
Morning, Mark.
And good morning to our listeners. We're back. I hope you guys had a great week so far. This is your host, Mark Yu.
And Wawi Santos.
And welcome to the Mark Yu and Wowie Show. Disclosure, this show is made for sharing purposes only and not to be considered investment advice. We record once a week. Technically, well, we missed last week.
Yes, we
But we're
did.
back. We're back. I and Wawi are both physical therapists here in the USA with the same passion and interest in researching and investing in our hard-earned money in the stock market. The show's goal is to share and learn from each other, answer questions, and to our co-workers in the medical field, thank you guys for your hard work. We are available on YouTube, Spotify, and Google Podcasts. On our previous episode, 19th episode, we discussed the jobs report, the failing China Evergrande's financials, the coming Fed hike, and obviously the flows and sentiments in the stock market. So on this episode, we're gonna briefly run through the jobless claims. So far, looks like Huawei, we had a very good report that came out. Jobless claims declined 326,000, better than expectations, and the continuing claims fell to 2.71 million, which is another decline of 97,000. So overall, looks like people are still, on track to getting back to work, which is a positive sign for economy. More jobs, more earnings.
Yeah, that's what I got on my radar. Also saw some increase in layoffs,
Oh,
but I don't have the article to show where I got that. But I read something that the layoff has also increased in line with the decrease in jobless claims.
But more likely, it appeared that there are more jobs replacement as a result. So, okay, on the next slide here, we're looking at the Michigan consumer sentiment. As you guys may have known, U.S. economy is mostly reliant on consumer. So this has been trending down since June, as me and Wawi have discussed earlier on previous episodes. But now we're seeing a slight uptick right here, which is a good sign. So meanwhile, the gasoline prices, in contrary in this chart, has ever been increasing. So one way or the other, people still have to spend money on essentials like food and gas to get to work or get to places. And now we're going to go on to our weekly sentiment and flows. So last week we kind of missed this, but this week now we're definitely going to look closer into it. Let's see what's up with the sentiment. So for the American Association of Individual Investors, which takes the survey once a week, currently, as of October 6th, a couple days ago, bullish sentiment has dived down a little bit, down 3% from previous week. So currently, we're at 25.5% from 28% last week. And bearish sentiments also decreased from 40.7% last week. Bearish sentiment has been lowered down to 36.8. So as you can see, more people are right now right in the middle in terms of their sentiment. They're unsure if the market's going to go up or down for the next 6 months. So people are trying to be a little bit conservative. Now we're in the early part of October. As you may have known, this is also the start of the fourth quarter of 2021. Just 3 more months or even less than 90 days. And it's going to be a new year, Wowie.
I
That
know.
quick.
Yeah, this year has gone by quickly.
Gone by quickly, definitely, sir. Lots of things have happened. And, we can't take for granted. We just have to take one day at a time, I guess, especially in the stock market. You'll never know what's coming. The fear and greed index, it looks like it has risen a little bit to 32 from last week's 27, but still it's in the fear side of gauge. So as you're going to look at the graph, looks like overall people are still fearful of the market, as I may say. We're still hovering at the fear side of things.
Yeah, there's still fuel to that because of because of the debt ceiling
Oh yeah.
recently. So for the past 2 weeks, we're kind of hanging over the cliff there
I know.
until they passed it yesterday.
That's crazy. Yeah, it's just
Mhm.
yesterday, fresh from the oven. It looks like we're gonna have a relief coming soon. I think it's until
Yes.
December 18th, right, Wowie? If you can correct me.
Yeah, if they
Initially,
didn't pass
mhm,
it, yeah, it would have been on December 18.
yep,
The cliff was on December 18.
right.
But it's a good thing that as you said earlier, pre-show, that Minuchin was able to negotiate, you know,
Mm-hmm.
some movement towards favorable action on that,
Right,
and that
right.
happened last night.
Mm-hmm. Like crunch time.
Yeah,
So,
at crunch time. It's always at crunch time.
mm,
If you look at past few years, they've always been doing that. It's like, what is going on? This tug of war every time on the budget.
right.
Um,
And yeah, we're gonna take a look in a little bit. Like, what if the U.S. didn't raise the debt limits? What are the consequences?
mhm.
Yep. Now we're looking at the volatility. So for the past 5 days, it's down 12%. It does mean that if the volatility is down, market probably is up. It acts as a contrary gauge, as what we have previously discussed. For the past month, although it's down for the past week, for the past month, it's still up almost 10%. So it's quite a rocky ride for the past month at least. And for the past year, the volatility, in fact, is down 27%. So it's almost hovering, well, almost, not really almost, but it's been hovering at the range between 15 and 25. Right now it's 1972. So it looks like we're just in the same channel
Mhm.
as a technical analysis would indicate. The Bitcoin cryptocurrency craze, now it's around 54K, right, Wowie? It's back above 50,000. Um,
Yes, it's above 50,000 right now. It's gone up to the middle range.
wow.
Um,
It's back up there because at one point in June or July, it's down mid 20s, I think 25, 24,000. The sentiment in Bitcoin, currently it's in greed mode, 74 from last week's. So fear mode, 27. That's quite a jump, 50 points up even. And for the sector performance of the corresponding stock markets, energy has been wild.
mhm.
Energy, oil and service sector, the drilling, the drillers, the what do you call those refiners, has been outperforming each and every segment for the past week, has been outperforming each and every segment for the past 6 months, and it has
Yes,
outperforming each and every segment, even the technology sector, even the bank sector, even the real estate sector, which is red
yes,
hot since the start of the year. Since the start of the year, the energy sector as a whole returned 40% compared to communication services like that of Facebook and Google, which returned 25%. Nothing meager, anything above 0% is great, but
mhm.
40% for the oil and drilling sector.
And in the following years, I expect energy to continue growth
Mm-hmm.
because there would still be a demand for that,
Right,
even though renewables are being integrated into the
mm-hmm.
market.
Oil,
We
uh-huh. Yeah, go ahead. Sorry.
yeah, oil. No, it's okay. Oil would still continue uh, uh, to be in demand in the future.
Right.
These large oil companies will continue to thrive, and
Uh-huh.
thinking, just looking at their current uh, situation financially, ExxonMobil
Oh yeah.
and
Mm-hmm.
Royal Dutch Shell,
Mm-hmm.
those are these big companies that would
Big,
continue to thrive.
definitely, yeah.
And
Mo-
they're
uh-huh.
innovating. They're innovating right now. They're also getting into renewables. So I think
Right.
that's a good movement
Uh,
towards the
mhm.
market trend.
I think Engine one of the hedge funds that won some board seats in ExxonMobil, definitely bringing some kind of like renewable, experience to the conglomerate, the stalwart, as you've said it earlier, Wowie. And also ExxonMobil, for dividend seekers, might want to consider, because they're giving out 5% yield in the days where, during now, that less than 1% are being provided by banks or savings accounts. And the thing is about that, Wowie, as I thought about it, um, oil has definitely lots of ways to go still. Saudi Arabia refused to hike their production just because they're satisfied right now with the range, which is up there, 70, $75 a barrel. Meanwhile, Russia kind of like tempered down, because they've been the sole supplier mostly of gas in Europe. And right now, if you're going to look at the natural gas prices there in Europe, it's way up there. It's like the used car index of our US segment here. So as a result, Putin kind of, not kind of, but decided to increase a little bit of the production of their natural gas. Therefore, increasing the supply kind of tempers down the demand. No, not the demand, but the price. More supply means a little bit, decline in the prices because of its, being made available to the public, or to the consumer. So briefly looking at the
I think that's Gazprom, right? Is that
yes,
what
Gazprom.
Russia? Yeah. So they're the same company that has the underwater pipes for
the Nord
the
Stream.
yeah,
Stream
the Nord
pipeline.
Stream. And
And
that's been completed this year.
oh yes, it's the pipeline 2, which previously, in the previous administration, Trump's administration, I think he blocked Putin to completing that, because that will give Russia really a good stronghold of gas supply.
Well, it already has,
Mhm.
especially now, to consider that Putin is still the president, right, of Russia.
Yes,
That's
yes,
what you call it, right? So
yes.
he's in full control. Russia has a good position right now
Good stronghold position of gas
on
supplies for
that,
sure.
on the natural gas
Yes. All right.
for
And
Europe. For Europe.
and for cryptocurrency, briefly discuss its performance. Bitcoin is up 16% for the past week alone. And what's BCH? Well, yeah, no,
I think it's Bitcoin Cash, if I'm
Bitcoin
not mistaken.
Cash,
Yeah, if I'm not
10%,
mistaken.
10% for the past week alone. And since the start of the year, Ethereum 388%, XRP up 350%, and
That would
Bitcoin,
be Ripple.
Ripple 350% since start of the year, Bitcoin up 89%. And for the indexes, for the stock investors, S&P 500 for the past week, it's down 3%. Dow Jones is down 1%. Nasdaq, biggest loser among the indexes, down 4.76%. And one highlight here is ARK, because we're going to take a look at an article that was published last night by Financial Times. ARK down 10% for the past week alone. So as we've looked about earlier, the volatility, even the volatility has subsided for the past week. It still has wreaked havoc on the market indices, because for the past month, it's up about 12%. So it has done some damage on the indices. This is for the past week. And for the past 3 months, actually for the past 3 months, the indexes are flat almost. Look at that. Compared, only S&P 500 is up 1.6%, or over 1 percentage point gain for the past 3 months. The rest are hovering between negatives 6%, negative 0.7% to positive 0.7%. Not even a percentage points movement in the past 3 months for all the indices. And since the start of the year, so all the indices are still holding some gains. Good news, looks like. Even the downtrend experienced earlier this week, indices have been able to recover, especially after the announcement yesterday of the agreement in terms of raising the debt ceiling, at least until December. S&P 500 since the start of the year is up 70%. Nasdaq up 16%. Dow Jones up 14%. This RUT or Russian 2000, which is a small caps, is also up 14%. Meanwhile, the most followed, or not the most followed, but the widely known index, ARK index, is down 10% since the start of the year. So this is what I was referring to. So people are thinking that there's still more downtrend to come. I can't argue that it may or may not happen, but so far, as of October 6th, Charles Schwab and Bloomberg data indicates that there are already a lot of stocks that are down since the start of the year. This is despite that we just discussed that most the indexes are up by mid teens, 13% to 17%. So S&P 500, despite being up 17% since the start of this year, 90% of the S&P 500 members, 0.9 times 500, or 450 stocks, largest companies in the US, are now down at least 10% from their record highs. 90, it's the same as Nasdaq, 90% also down, almost all down about 10%, while Russell, those small stocks, 98%, almost all of the 2000 small cap stocks are down 10% since the start of the year. Average member decline from all-time high, or at least this year's high, Nasdaq experienced nearly 4%, 40%, or 4 out of 10 of its stock average member decline. Average member, I'm sorry. In average of the Nasdaq in the stocks, 40 they have already declined at least 40%. So some of the Nasdaq members have more likely experienced more losses. Because if you're gonna cumulatively average all of the stock performances, not everybody is down 40%. Obviously, Facebook is slightly hovering. Let's see. For example, if it's gonna be, we're gonna look at Facebook, with its recent issues and hearings with its whistleblower for the past year, it's still up. Look at that. Believe it or not, Facebook is still up 22% since the start of the year. So Nasdaq indicating here, this table by Charles Schwab and Bloomberg, there are members definitely who have fallen much more. So as you've said earlier, Wawi, the big tech, the big ones are the ones that keeping this index up. But most of the stocks are in correction mode, which is already down 10% or more.
Yeah, I would like to see more of the small ships, the tugboats, to kind of help, push these big ships forward as well.
I know. I think
that would be the ideal market, right?
True.
When you have the smaller companies compared to the big members,
right.
pushing each other along.
Right.
Hopefully we should see more of that once we hear more about how they're gonna manage the debt ceiling. Looks like they're gonna put us on the precipice again in December.
Right. There's gonna be discussion, yeah, for sure.
So expect some volatility around December, when they start having that discussion again regarding the budget.
And you know what's up again? What's gonna come up again in December, Wawi?
No, what is up?
Be a possible Fed rate hike in this year.
Yes. Yeah.
So
okay.
It might be we might be in for a ride again this December. Oh my gosh, that's 2 months away. Yeah, that'll be crazy. And also in this chart that we're showing right now, earnings are plummeting toward negative territory. At least the gauges, earnings revision. Most of the companies right now are revising their earnings expectation downwards which is also not a good sign if you want to see continuous growth. If anything, I believe the big techs, those big conglomerates, Facebook, Google, the FANG stocks, are still going to be able to realize better returns on their earnings. But overall, this won't help the smaller companies for sure if they keep revising their sentiments, earnings revisions. So if they don't meet these revisions, then we're in for a ride for sure. And right now, the small caps, 98% of them are already down at least 10%, if I'm not mistaken. Let's look at that. Yeah, 98% of them are already down. So the one that's holding up on this market for sure are the big ones. And the flow. So this is like captured as of last week. Largest inflow to banks and energy since March of this year. A big amount of funds had flowed into banks and oil. So it looks like they're trying to capture that reopening trade once again, Huawei, on this point.
Yeah, so that's a good thing because the past 3 years, 3 years to 5 years, energy has been underperforming.
Yeah.
So it's a good thing that we're seeing a rise back, and that's putting us back into reality that, up to now, we're still reliant on fossil fuel to produce products. Okay, it's not just how to get our cars running, but we also need this petroleum to produce, products like plastics and stuff like that.
Right. And I think because of the ESG.
Yeah, the ESG trend has been going on for several years, but a lot of the, execution and implementation has not been put in place. We still don't see houses like, like massive scale houses having solar panels and producing their own energy. There's there's pockets of places and people and businesses that are using that technology right now, but no one has been adopting that technology because of cost.
Right.
Now, the country that's doing a lot of these changes that has dropped the prices of solar panels would be China. They also have dropped the cost of producing and selling battery packs.
So what's the company called that Buffett invested in? I think it's BYD, right? The one that makes the most cars, electric vehicles over there. But yeah, definitely. So the reason why I mentioned ESG is because back like a year ago, a couple of years ago, when they started like saying that we're gonna pull back from energy, like you said, and now this year they're skyrocketing. So I think some of these funds, like the fund flows, are going back in the FOMO sentiment. So this is also a little bit of a warning sign if you're more into reading into the flow. So most of the time, you really don't want to be following the trend. So you want to be there when it's not that hot. So right now, energy is definitely making some waves. So and the flow is coming in. So I'm not saying it's already the top. It's already too late, but it's up to you if you want to go pursue it. It's just the data that's showing that people are going back to energy. So this is an article that I saw about 4 days ago, published by Market Insider, entitled "Most American Investors Now Expect the Stock Market to Crash as COVID and Inflation Worries and a Summer of Optimism," says Alliance survey. So byline goes with 54% of American investors see the stock market heading for a crash. The Q3 or third quarter survey found respondents worried that Delta infections would pull the US back into recession. Clearly, the recession is determined by NBER, or National Bureau of Economic Research, once there are two successive quarters that are negative GDP growth. So 54% or more than half of American investors think that we are on our way to another recession we just came back from. Survey respondents also expected multi-year high inflation to eat into their purchasing power. So the higher the inflation rate, the lower the dollar value is. So you need more dollars to buy a certain good. Like for example, the Big Mac thing. Back in the 90s, back in the 80s, it was just selling for probably cents to get a Big Mac meal. Now it's $4 for a Big Mac meal. So it means more dollars is needed to purchase goods. According to a
Well,
quote, go ahead.
there's been a downtrend on COVID-19 infection. So
Yes.
that's one factor that we have to consider. Since it's going down, then our main concerns here would be how resilient the companies are moving on towards the winter,
right?
And how prepared we are for another winter Armageddon.
A possibility, but right now Pfizer is trying to apply for the for FDA approval for a vaccination of younger individuals, which are now having more infection rates compared to the older ones and the working class for sure. And as you've said, the cases are coming down, but this in surveys came at an interesting point. But remember, in Monday, stock markets weren't really doing so good because of the debt ceiling talks, and now we've bounced back up. At least we're hovering less than 1 percentage point for this week.
So that tells you where the sentiment is tied up. It's tied up on the debt ceiling.
Debt ceiling, and this one is just supplementary. The possibility of another recession, which I think is probably really recession might be a really strong word at this point of time. According to this article, Kelly Levine, Vice President of Consumer Insights at Alliance Life, which did the survey, people were feeling better about market risks to their retirement this summer when we saw that brief return to normalcy before getting a Delta-driven reality check. So I think they did the survey just this summer or a little bit after when the COVID Delta variant is really trending. But now I think the survey is like in hindsight. Even though it's published 4 days ago, I think this is already in hindsight. The debt ceiling is the one that I think is one of the red hot, issues, which has been resolved at least until December. We can breathe a little bit because of that. Yeah, so sudden about news cycle changes. So if you're not with the news, it'll be hard for you to decipher what's going on.
So hopefully some of our listeners are hearing our discussion today.
Right.
And I'm thinking about selling on the strength, like some are doing, in order to prepare for a possible correction or volatility in December. And but you can never predict this. This is what we always talk about. It's like kind of stupid to predict, but you kind of gauge, right? You kind of measure your risk.
It's good. It's good to see you. It's good to have like some sort of a view of what's possibility that might happen.
Yeah, and know your your action. What will you do, right?
Yeah.
So these signs. You see the data, you see the news, and usually you can depend more on the data than the news, but you can somehow measure your risk at that point if you need to do some short-term actions. Is all I'm saying. So what I'm thinking is, if you have the accumulated data showing that things might be on a correction or volatility may increase, and you want to take some opportunity on that, then you can, at this point, you may want to sell on the strength. Okay, again, that's not a financial advice. I'm just saying what I'm thinking.
There's a possibility in order to be prepared for a pullback, and you have to, to take advantage of a pullback, you got to buy, right? And you have to have the funds. And so that's a good point right there. Yeah.
So what I'm saying, that's a rational action, right? So that's a logical action. You measured your risk. Okay, this is what I'm gonna do. Stick with your plan.
Right. And as we have discussed before, time in the market beats timing the market. So if things don't happen your way, it may be a big chance for you to not be able to enjoy the bump or the uptrend of what the market does. But who knows? Hindsight is 2020. We never know what's coming. But
Exactly.
it's always good to be prepared. So this article also came in a day after the article, the negative article that the crash is coming or recession is coming. This article's title is "Dip Buyers Continue to Show Signs of Fatigue." So as we've discussed in a previous episode, 19th episode, just buy the dip. So it
They're
says
running out of cash.
they're running out of cash. So it says here, dip buyers continue to show signs of fatigue. So interestingly, this is published on Tuesday, I believe. Yeah. And during that time, people are still panicking about the debt ceiling and the market's not been doing good. It's been down 300 points, another 300 points at the open. So this article includes the latest survey from B of A or Bank of America, quote unquote, from Jill Carey Hall, quote unquote, sales were primarily in large caps while clients bought small and mid caps, a reversal from trends earlier this month in late August. So people are dumping their large tech. I'm assuming it's tech stocks, the big tech. Sales were primarily, sorry about that. Next, but consistent with recent signs of stock picking over passive. Clients were net buyers of single stocks for the fourth week and net sellers of ETFs for the second time in 4 weeks. Biggest sales of ETFs since last October. So stock picking is in. ETF is slightly being outfavored. Flow sentiment in energy has grown more decidedly positive for the past few months. One of the few sectors where clients have been buying both single stocks and ETFs broadly. Surging commodity prices, a broad inflationary backdrop, and attractive inflation-protected yield support our overweight view of the sector, which is still underowned by active funds. So it looks like people are definitely buying into energy
How
because of
about
inflation.
financials? Are any movement on the financial sector
Yes.
consistent with energy?
Uh-huh. Financials, meanwhile, also received the largest inflow since March 2021. I'm sorry. And their performance, yep, financials is catching up for the past week. Yep,
They're
you're
second.
good. Yeah,
They're
they're
second.
second for this week, even though the market is down slightly. Energy is number one, obviously, red hot sector because the oil price is going up. Financials are catching up. These are the reopening plays.
So if
Uh-huh.
we have the tapering,
Mhm.
when they ease off on the gas pedal,
Right.
we should see financial move
Yes,
up, up a little bit more or
I agree.
significantly more,
Mhm.
once they, ease off on the gas pedal.
Yeah, I agree. Because interest rates will slowly increase, and it's always good for the banks to have higher interest rates so that they could earn more from their loans, which that's where they get most of their money from or profits. And if you take away that performance chart from since the start of the year, if you're gonna take away the big tech, the top two performing sectors will be energy and financial. So people are right to go into the reopening place even the start of the year. You'll be doing fine, even though with the corrections coming right now. Like the people have been counting the days that the stock market hasn't experienced 5% dip, which this week we just had. So the bear should be happy by now because we just experienced 5% drop, but we're again recovering from it as of yesterday because of the deal with the debt ceiling. So this is an article this morning by Seeking Alpha. Today's jobs report should provide a clearer tapering timeline. So it's all about tapering. Wow, it looks like if we have good jobs report this morning, would we hear from the Fed that they're gonna taper by this December? And one more thing about the December timeline is the what was the one that we were just talking about, the debt ceiling
The debt ceiling talk.
adjustments? Yes. And I don't know how Evergrande, how's Evergrande doing right now, but they're 3 days away from their multi-$100 million debt interest payment that previously they already missed. So right now they're not making waves, right, Huawei? That debt ceiling has taken over. The sentiments from China has subsided. Looks like it's
Yeah.
been waning down. So hopefully they don't make a turmoil once they miss the payments on Monday, and make a new headline news that will threaten the stock market. I mean, personally, real estate in China, I see some experts saying that it could harm, like, globally, like it could infect other nations. But personally, I think the banks here in the US, the builders here in the US are well equipped in terms of their cash. This is not like back in '07 and '08 where ninja loans or no income, no job loans are being provided. Um, Banks here, as you may have underwent, it's up to you if you want to share, but here in the US, it's not that easy to obtain a loan, I would say. There are lots of requirements. Part of it is, I think, the 2-year history of income. If you don't have the 2-year history in income, I don't think you can even buy a house at this point in time.
Yeah, so since we changed regulations and we don't want to get in the same boat like we did in 2008, 2009 crash.
Yes.
Because of subprime lending, where
Subprime, yep. That's the
the,
term.
the the banks are very careful about lending to people right now. So
Exactly.
in my experience, like with my recent uh, um, transaction trying to secure a loan for my new home, I had to address like 21 line action items.
20. That's a lot.
No, 25.
Oh, 25.
As
Okay.
of this time to secure the loan.
Mhm.
So, I have to state my position, how much, regarding my assets, where it's
Right.
going, stuff like that,
And I think
to secure a loan.
these lenders also call your workplace just to make sure that you work for that for that employee.
Yes.
If
Yes, they
they don't,
will.
if they didn't see that you're working actively, then they'll probably just refuse or deny your loan. There's no way that you can obtain a loan without any history, job history at this point in time. So, I mean, there's no way. I mean, maybe sentiment wise, they could influence the stock market temporarily, like what they did a couple weeks ago when Evergrande missed their payments. Now it's not no longer Evergrande, Wowie, right? You see in the news, I think it's Fantasia or Fantasy and Sunak also experiencing some debt issues. So
I think those situations with Fantasia are worse than Evergrande. You have to look at our company's exposures to China.
Right.
So I haven't heard how large of an exposure some of our companies or hedge funds has on Evergrande, but you have mentioned
I think BlackRock. Yeah, BlackRock
having a 400 million stake on.
Yes, sir. That's a good
but
amount.
that's just like a very small drop.
Yeah, $9 trillion assets
on a 9 trillion AUM.
Yeah, that's crazy.
So I think we're somewhat shielded on what's going on in China, but we will be, we'll have a little ripple effect on that.
I couldn't agree more. Yes.
We might see some companies that are overexposed to Evergrande, and that may come out maybe in a couple of weeks. But that wouldn't be the big
October 11, guys.
companies.
Yeah, October 11 is a critical day. Monday. That'll be a Monday and again. And remember, Evergrande news hit the news wires like Sunday night. Wall Street wasn't prepared for that, but now hopefully people are more anticipatory of what's gonna happen. But the thing is, Wowie, it kind of reminds me back in January, experts, Wall Street experts, are sounding that China is actually, or emerging markets are really a good place to be in. This is before Tencent and Alibaba had dropped like a hot potato. So those hedge funds are being screwed right now for sure. Those who had heeded to their advice and put their money there, I'm pretty sure they're screwed up because my portfolio, part of it, which is exposed to China, is still treading like water, like negative 20% or even more. So it's not been easy. Emerging markets has not been good to investors who would have otherwise, thinking about diversifying from the US. US markets are still the cream de la cream as of this point in time. In my opinion, I don't know.
Well, I think so. I have to agree, comparing
Mhm.
it to the European market and Asia Pacific region.
Mhm.
Although, you see some strengths in, well, this is what I'm seeing just on my radar.
Yes.
Korea and Japan still remain strong. But
Mhm.
again, we can't underestimate China.
Right.
The current US president will have a virtual meeting with Xi Jinping.
Uh-huh.
So that's a good sign that trade relations might fare better again
True, true.
in the future. So if you're invested in China, China is still the one of the biggest market, biggest growing market
Right. Right.
that we have. The potential is there.
Mm.
So I wouldn't discount it. I would listen and see what kind of trade talks the US and China will have.
Yes.
Because if you look at the bigger picture, the US still needs China. China can still produce a lot of products that are still, cost
Oh yeah.
effective
Yeah, for
at
sure.
this time. Although shipping costs have increased,
Uh-huh.
we,
That's what
we
I'm
should
gonna
see
go to in next. Yeah.
we should see some normalization, or
It's
maybe.
crazy, yeah. Right now,
mm,
per 40-foot ship, 40-foot vessel ship, we're hovering at all-time highs, like way up there. I don't have the chart right now, but I just saw it this morning as I was reviewing some charts. Like the transport, the logistics, the shipping. I bet only the big guns here in the US can afford to hire or send their products here in the US because of delayed port delivery, the dwell time, it's
mhm,
soaring, and the
mhm.
cost of goods to be shipped, it's incredible. So that's one thing to watch out for. Hopefully, the talks bear some fruit, but I don't know how they're gonna keep up. Like right now, for example, in addition to the semiconductors that are being being constrained, we're lacking a lot of them, and already impacted a lot of car production. What else has been, in addition to that, there are a lot other stuff that's being like in short supply at this point in time. So inflation is here to stay, in my opinion, for a little bit longer instead of being transitory. So
Exactly. So that's a
mm,
good insight. But you
uh-huh.
have to look at the number one factor, okay? And we're seeing a downtrend. The number one factor, in my opinion, was COVID-19.
Right.
This slowed down production. Put people, on quarantine, so there's not people to, uh, work on the docks. They have to close the docks, the ports.
Right.
So number one factor would be, COVID-19, and now we're seeing a downtrend.
Mm.
Unfortunately, as far as the supply chain, when it comes to shipping, some people that were affected by it see a 2-year correction on that
For your correction, yeah.
before
Yeah.
we see a normalization of supply. So if you're on
Yes.
shipping right now, if you're invested in shipping, you should see a good chunk of an increase in your stock price,
Right.
because
Possible. Uh-huh.
I'm just looking at Hapag-Lloyd, for the
Uh-huh.
year, $24.62, and now they're at about 107.
Oh
So
dang.
that's a fourfold increase.
400%. We missed that boat.
Well, I
Dang.
kind of got into that boat a few
Oh
months
nice.
ago by
Okay.
taking this Israeli company called Zim.
Uh-huh.
And although it's on the downtrend right now, it doesn't own as many ships as Hapag-Lloyd. They're kind of just like contracting middleman.
Uh-huh. So their
Uh,
logistics, like,
their
yeah,
logistics,
ship.
and they can negotiate their price.
Mm-hmm.
Um, so so the companies have to be agile, right? And the big
Mm-hmm.
companies have the ability to be agile. And look at Costco, look at Walmart.
Mm-hmm.
Who else? Who else
Ross
hired
stores.
Ross?
Amazon.
Yeah, so they got their own ships to move their cargo,
Mm-hmm.
right?
Yep.
They got trucks to move their cargo out of port.
Mm-hmm.
The the only thing here, again, the small businesses are the ones that are highly impacted because
Yes.
they don't have the agility financially to get these big ships.
That's a really good point, Wowie, because like for me, for example, if I want to sell my products, the biggest store online, believe I mean, there's no judging it or there's no contradicting it. The biggest store online is Amazon. And if you want to sell your product to lots of customers with lots of what do you call this? Lots of exposure or views online, you need to have your product in Amazon. And in order for you to sell the product in Amazon and have it shipped within its 2-day program, you have to deliver your products to Amazon and pay some sort of a fee for storaging your stuff in there. And if your cost will increase just to get your products here, I don't think you're gonna even have any profits in the end. It's hard. So you're right. Small businesses will be struggling. Big businesses will be even getting stronger or bigger or swallowing other small competitors. But yeah, let's jump on to the next topic here, which is good news to one of our friends there in Austin, which we interviewed. If he's listening, hello to you, Pee Wee. Another good news to you. Pee Wee, as we have interviewed in episode 13, I think, yeah, episode 13. He's been in Austin for quite a while now, and he's been investing in real estate over there. So he's also an investor in Tesla, like you, Huawei. And I myself is invested, but a couple of shares, not so much. But Huawei's portfolio has been, started with Tesla, I believe. And
Yes.
this is a news that just came out last night, October 7, 8 p.m. Elon Musk makes it official. Tesla moving its headquarters to Texas. Where in Texas specifically? Austin, Texas. So now they're tired, I guess, with the politics or expenses there in California and the ever pending increase in taxation of their residents. So they're moving here in the new Silicon Valley, in my opinion, of the USA, which is Austin, Texas. Which, if you guys haven't been there, it's ever been growing. Traffic is crazy. If you love that lifestyle, man, good luck. Move to Austin, Texas. But yeah, he's moving his company there.
I think I haven't been in Austin in about more than 3 years.
More than 3 years, man. Wowie, traffic is nuts. Well, for me, I have the luxury to be able to afford flying in and out of that city because I never wanted to drive through it. Before I had to move, I had to drive through it, which during like 3 or 4 p.m. during my travel, I got stuck in traffic. It's not even rush hour that time, and I was stuck. And that was like a little over a year ago. So this is Tesla's stock price. For our listeners, some of them already know Tesla is the number one holding of ARCs or Kathy Bay's ARC innovations. Right now, it's $794 a share, which is ever so in rising. It was down as low as 577 back in May. It has regained almost over $200 a share, and now it's climbing to its 1-year high. 1-year high is hovering around 883. So right now we're at 794. It's not that far from hitting another year high, which is still a possibility. We have 3 months to go to December. So this is an article from Financial Times entitled "Cathie Wood's Flagship ETF Hit by Record Outflows in December. Short seller bets against ARK deliver returns of more than 9% in 1 month." Wall Streeters rejoicing as ARK innovations have been downtrending. Since the start of the year, those short sellers have gained at least $407 million. And on that camp, as we have discussed on our previous episode, this is a big short, Michael Burry. And among other stuff, among other famous investors, they're piling against the innovation that Cathie Woods is bringing to the table. On September alone, these short sellers had at least profit of $237 million, a return of 9%, which is impressive. People are going against the grind, I would say, but as we have looked at the performance of ARC Innovations, it's been down at least 10% since the start of the year. Yeah, 9.55% down. So not a whole lot of investors happy with the ARC Innovations performance. As a result, most of the funds are pulling out of the ARC Innovation Fund. As you can see in this chart, there's a big dip right now because of the funds. And overall, the assets under management from as high as 25 billion, it's down to 19 billion. 19 billion at the end of September. Which isn't bad, 19 billion, that's still a lot of money, right?
Yeah, it's still, and if you came on board December of 2019, you would still be up 100%.
You still
If
doubled your
you,
money, looks like.
yeah, but you have to look at it. People are looking for value right now and stability. So some are going into the dividend play and
Dividend play,
moving
yeah.
back into the value stocks and
Right.
the income trend too.
And on this slide, U.S. stocks advance on debt ceiling. This was published yesterday, which meanwhile we already have talked about. If you're more into details, briefly, so stocks is said in the article. I'm just going to read a couple paragraphs here. Stocks on Wall Street zoomed higher on Thursday after U.S. Senate reached a deal on a stopgap measure to extend the debt ceiling, avoiding a U.S. government default for now. The proposed agreement would increase the debt limit by 480 billion, enough to fund the government through to early December. So take note of that, guys. Early December, that's a critical date. As fears of a default abated, investor ditched safe haven assets as treasury debt in favor of riskier opportunities such as stocks. So what happens if the US will start missing payments like in December if they didn't meet another extension? It says here in this article, I just pulled this off of Google. So yes, the US will start missing payments, including Social Security, if it doesn't raise the debt limit. If the government runs out of cash before raising the debt limit, it would be unable to pay all of its bills on time, such as making a default, including the programs like Social Security.
And I think salaries too, right? If you're working for the US government.
True, government officials, they'll stop coming to work and, shut down again all over. Which isn't good overall for the economy. So on to our next slide before we hear the video clips of the week. A brief update on our real estate crazy real estate market. This is an article from Bloomberg entitled "California's Median Home Price Seen Topping $800,000 in UP." If you want to buy a home in California, a decent home, you probably have to pay around this value, $800,000. Median, that means at least 50% of houses sold in California have priced at $800,000. So that's a lot of money. This is the highest it's been since the history of this information has been provided. Quote unquote, from Jordan Levine, chief economist of California Association of Realtors, quote unquote, demand for homes will continue to outstrip available supply as the economy improves, resulting in higher home prices and slightly lower sales in 2022. Interestingly, he said that. Slightly lower sales. Okay. So that kind of like, if there's demand, it should be higher sales, right?
Yes.
But I guess slightly lower sales. I don't know if this is typo, but I guess there's still demand. Maybe it's because they're not producing as much homes.
Yeah, there's still a supply problem.
Supply, yeah, probably more likely.
So some builders are having, again, goes back to the shipping problem. Fixtures are hard to get by right now. Paints are hard to get by right now.
Right. Well, I guess that makes the point there. It says here, California is home to 4 of the 5 most expensive U.S. housing markets. So guys, if you're buying a house, think about it again. If you're buying a house in California, think about it again. It's home to 4 of the 5 most expensive U.S. housing markets. So just for the heck of it, I'm going to go to Google's mortgage calculator. And let's see what type of monthly mortgage payments are you have to make on an $800,000 mortgage. So usually for 800,000 and you did the 20% down, you're going to be paying 600. You're going to take a loan for 640,000, which would now at a 30-year fixed rate of 3.5%, you're going to be paying mortgage of $2,800. That's without taxes yet. So probably around $3,100 a year. That's without insurance. A month. $3,100 to $3,500 monthly payment. So you gotta be making a good money there in California if you're gonna be thinking of affording a house in California. So this is an interview, Bloomberg interview that just happened a couple days ago. For those who watches Shark Tank, you guys will be aware of this lady. She's a very nice lady. Her name is Barbara Coran. So this interview is entitled "Housing Market Has Gone Bonkers," Barbara Coran says. Let's roll the clip.
Small business and all, like you invented. I need to talk to you about the pricing of housing in America. I just looked up at Corcoran Group, and I'm going to pay $34,000 on taxes on a piece in Brooklyn. How have we done this? How have we priced America out of real estate?
Well, most people are priced out of the market. You're exactly right. The market has been going absolutely bonkers with no end in sight. Now, prices nationwide have gone up 18%. I've never seen an increase like that in the 30 years. The last 30 years, I think, was the last time. No one could believe what's going on. In fact, if you want to buy a house, I don't know how you did on your purchase, but everything's being sold in bidding wars, and 60% of the houses. I mean, people are so uncomfortable, and yet they keep paying the prices, and there's no end in sight.
Barbara, I looked at the regression rather of housing in 04, 05, 06, and you know what? We regressed back to the mean. You lived that at Corcoran Group. Are we going to do the same thing this time?
I did.
Are we going to do it again?
No, it's not the same kind of a market. No. You know what you have? Today's market is fueled by individual buyers who want a better place to live. They bring their businesses home. They want to raise their kids. When we had that drop off, it was fueled by investors, house flippers, poor mortgages that shouldn't have been mortgage companies that should have been lending money at the time. I mean, it was a false market with a false bottom, and it fell. We're not going to have that now. I'm just hoping that the prices cool down a bit, because as you started to say just a minute ago, so many people are left out of the market. It just seems unfair. Just to have a house, you have to feel like you have to be a pro investor bidding up the prices. It's just insanity. I've never seen anything like it.
Barbara, this is for individuals, but it's also for small corporations. And I know you do speak with a lot of them. I'm wondering how much this dampens their enthusiasm, their optimism, their willingness to hire, to expand, if the fixed costs are going up as quickly as they are.
With the fixed cost going up for business, that's not always true, all right? Commercial rents are much lower than they were. If you were talking about business, I'm assuming, right?
Yes. Yes.
Yeah. So their fixed costs are actually lower. People are renting less space. People who have large floor plates in large metropolitan areas are negotiating their way out of the leases. They're subleasing the space. Retail prices have come down. No one wants a large retail space anymore because it's a shop front versus holding all of the inventory. They don't do that anymore. They sell it online. So actually the cost of doing business has come down. And of course, the main problem with all of business right now is finding the right people. That is the single largest challenge, whether you own a restaurant, a shoe shop, or a giant corporation. Hiring and finding and luring in the right people has been the biggest challenge.
But Barbara, we have not seen the increase in wages that we would have expected given all of the labor market shortages that we hear about. In fact, it still lags behind the pace of inflation. Bill Dudley, formerly of the New York Fed, was just on the show, and he was saying he thinks that it will accelerate pretty dramatically in the near term. Do you see evidence from small business owners that they are willing to pay up that much more dramatically in the upcoming months that will lead to that kind of wage inflation?
You know what? They're going to not have a choice. So far, they've had a choice. They've cut back on their staff. They intentionally cut back on their overhead. They got rid of everybody they really didn't want working for them during the pandemic. I mean, all these companies slimmed down and got their house in order. Whether or not they're willing to pay a higher wage remains to be seen. But so far, They are not. People are holding on to their profits and are very reluctant to let any of that money out. It's just, it's more, I don't want to use the word selfish, but I would say, yes, people want to, a little greed has set in, but they're going to have to give something.
Barbara, one final question. You in support with AT&T are actually out there talking to real people. These are webinars and things like that where Barbara Corcoran, folks, is talking to people about small businesses. Let me raise my hand in the back room of the Zoom call. Barbara, could you do now what you did then?
Yes, I could, because you know what? The pandemic has proven that, and that's what the purpose of the Business Unusual webinar series presented by AT&T actually is. We're trying.
I think this goes this goes away from the topic, but yeah, looks like real estate has gone bonkers, and she's hoping for a little bit of a a correction, not correction, but a slowdown in rise in prices, because a lot of people are getting left behind for sure. Oh, Bobby, you're on mute.
Oh, I'm sorry. And she made a good point about increasing wages.
Right.
And some of our folks, need that to cope with the rising cost of everything.
Right. And this graph right here, I was able to pull up. It shows from realtor respondents, like nearly all of the states here in the US expect somewhere between 0 to 2% increase of price in the next expected sales change, at least sales growth. They're still looking at positive sales number or increasing sales for the next 3 months.
Yeah, look at Vermont and South Dakota on that map. Yeah, South Dakota got into my radar this week and I just forgot. But yeah, something booming there.
Yep, positive 4 to 6% rise in sales. People are moving there, or I guess they're buying more houses over there. And then market index, realtors buyer traffic index and seller index is still like mostly green. It's still positive. Cash sales as percentage of residential sales is still hovering like within average 22%. So just imagine offering cash in one home. Market conditions.
I almost thought about that, having to go through all those line action items. I said, would I have saved so much trouble if I just paid this in cash? But I still made the decision to go ahead with the loan, because if you keep your money in the stock market, chances are still better that your money will improve over time.
It could go further, yeah.
That's based on compounding again and time value.
Right. And market conditions is still improving for the overall real estate market. And for the landlords, percent of rents collected from residential tenants in the past month, ding, 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 97% of rents are collected. So real estate has stayed rock solid here in the US for sure.
So she said that on that interview, she said that rents actually are lower. Is that correct?
Oh, that's for the office. Yeah. Office.
Oh, for the office rents.
Rental spaces. Yeah. They're subleasing it. They're renting less space because of the work from home, I think. Yeah. But overall, yeah, it's been also retail sales. But the thing that she highlighted also as well is the main challenge is to hire the right people or fill the gaps, the employee gaps in their stores.
How about the housing rental?
I think housing rental has been increasing as well, right? Has been increasing. I think we discussed it a couple episodes ago where rents accompanied by the prices have been increasing by double digits. So this is an interview for the overall outlook of the stock market. This is Tom Lee once again. This is a CNBC interview held last week entitled "Tom Lee is Still All In on the Markets." 52,000 views in CNBC. Let's roll the clip.
Bringing our headliner today. Let's just get right to him. Tom Lee, FundStrat managing partner. I might as well call you Mr. All In, not Jim, because you've been all in for what seems like forever. Are you still looking at 4,700 on the S&P 500 by the end of this year, Tom Lee?
Yeah, I know September was an ugly month. really tough, down 5%. But in the scheme of a market that could end the year at 4,700, I'd agree with Josh and all the other panels that that's just a swiggle. As we zoom out, it's going to look like nothing in 12 months. And I know investors are nervous and there's a lot of headwinds here, but as you know, when the wall of worry is big, that's also a good opportunity for investors.
I know, but why did we have such a bad month of September? I mean, it's seasonal, I get it, but it's more than that. And now we're entering what is also a typical tough month, and that's October. I feel like we're just brushing off what just happened in September as if it doesn't even exist.
Yeah, it would definitely, there was definitely a message coming out of markets in September. Because it really puts us at that knife edge of if you're half full or half empty. Are these inflationary pressures we're seeing signs of good demand, or is it stagnation? Is Washington turmoil something that gets resolved, or does it get worse into 2022, 2024? Are we at peak everything? Is rising rates bad or good? I think there's a lot of questions, but to me, I think, and Jim mentioned this, and Stephanie, the fact that cyclicals outperformed in September, to me, is a really major signal. It says that economic resilience is strong. We're definitely seeing a mix shift in the stock market. And I think people are quite exhausted with COVID. And I think the fact that Merck does have a pill really does alleviate those concerns about vaccination penetration. And it would be a very convenient and, as Dr. Gottlieb says, a game-changing solution. So it's a positive catalyst.
I get you, but rising rates are in their own way a game-changing situation for stocks and multiples and valuations. And if they do start to go up, multiples are going to be depressed. We can't ignore all of the things that you just said are undeniable positive, but they come perhaps with even higher rates than what we have now, anticipating an even stronger economy in the months, if not years ahead, once we can say, okay, COVID's endemic, but it's not paralyzing to us anymore.
Yeah, that's right. I know the market cares about rate of change. So the fact that rates have gone from 1.1 to 1.5 is concerning because it is a big basis point change. But 2 years ago, if we asked investors, is the S&P going to have multiple compression because interest rates are at 2%, nobody would really have considered that level to even threaten the bull market. 2 years ago, we would have said 4 to 6% would be the risk of the issue. So I think as people look at 1.5% today, or even 1.8 or 1.9 or 2, it's not really a level that burdens companies. It doesn't really burden homeowners. It doesn't really burden people with debt. And I don't think it should burden equity holders.
Now, you've been sticking with your call as well of stay overweight FANG. And those stocks have been tricky lately at best, right? They feel like they're in the midst of a last September, a year ago, weakness, right? Now, the market was okay because all of the other stocks did well. You get my point, right? There was a lot of slack to pick up the weight. And I'm just wondering if that's going to happen again. If those stocks weaken for a more prolonged period, what that's going to mean to the overall story.
Yeah, that's a great question, Scott. Last September, the overcrowding in FANG was significant because they were your stay-at-home play. It did save people's bacons to own FANG for not only 10 years, but throughout the pandemic last year. But in 2021, FANG's not as crowded a trade. So the fundamental question is going to be, are FANG margins at risk because rates rise? Our quant, Adam Gould, did a great analysis, shows that FANG operating margins actually could rise if rates are rising.
Really?
And FANG's relative performance during inflationary periods is actually quite good. So I think we're fearing something in FANG, but because it's not as crowded, I think they have the capability to rally pretty strong.
Wow. So even with the reopening place favoring financials, Huawei, looks like FANG is still gonna be able to generate even more profits according to their quant, which is a very bullish indicator, as I would say.
If you look at it, you keep holding.
Keep holding those FANG stocks or buy the dip.
Yeah, remember they're large and they don't have many competitors.
Right. And I guess we'll just roll this clip. We're going a little bit over time on this episode just because we missed last week. So definitely we're discussing everything that just happened for the past couple of weeks, guys. Thank you for sticking with us. If you guys have any questions, submit it to markuwawishow@gmail.com. All right, let's play this clip by Morgan Stanley. So in contrast, this is quite a contradictory view or bearish view about the stock market. This interview was held on October 1st by Bloomberg, 36,800 views, entitled Morgan Stanley's Wilson sees 10 to 20% correction led by big tech. Wow.
Mike, I want to go 60,000 feet on you. We have had a stretch of disinflation from Volcker to Mike Wilson right now. Do you sense that this is a nuance within a bull market wrapped around fixed income, commodities, the rest of it, the dollar, et cetera? Or are we at a point of a major change in the vectors to 2025?
Well, look, I mean, we've had that view for a while. We felt like last year's pandemic was the catalyst to kind of move us out of this disinflationary, deflationary world we've been in for 20 years, quite frankly. A lot of other things, were happening before the pandemic, deglobalization, some of the populist movement, which was talking about, inequality of wealth and income, and that train had already left the station. So the pandemic, which, by the way, pandemics are typically inflationary. So that was a perfect foil to get the transition from monetary policy dominance to fiscal policy dominance, and it's begun. And normally it happens with what I call a kickoff move, Tom. When you see big trends change, you get a big kickoff move, and that's what we've seen in all the inflation indicators. My best guess is it'll settle down, but then the trend is changing. And so it's going to be a long journey ahead. It took us 35 years to get here. It's going to take us 35 years probably to get to the peak in rates. It's going to be a slow moving train. And essentially what I'm saying is buy the dips on inflation.
Mike, the equity market, you're looking for a 10% move lower on the S&P 500. We've had 5 percentage points off it. Are you seeing with increasing confidence it could be worse than that? It could drift towards that other level you were looking for, a 20% move. If you are, why?
Yeah, John, last time we chatted about this was kind of after we made that lean. It was prior to the situation in China with the property development company. And, look, I think what happened here is, we've got more data on the idea that not only are we getting a tightening of financial conditions from the Fed, lower multiples, but we're also getting a greater slowdown than perhaps is expected now. We're seeing the earnings numbers. You guys have been talking about the cost pressures of supply issues and constraints, but there's also this payback in demand thesis that we've had for quite a while. Our cost thesis is playing out now. People are aware of it, but I don't think they really appreciate how much payback and demand there's going to be in these areas that we overconsumed. Okay, so the bottom line for us is that risk has increased, and it's not our base case yet, but clearly moving that way.
Mike, touch on this. You've touched on it briefly. Build on it for us. What we've seen over the last several months has been so well flagged. It's talked about so much, so well known, and yet clearly from your perspective, poorly priced. Mike, why is that?
Well, it's not poorly priced at the stock and sector level, right? We've talked about this too, John. It's been basically a rolling correction since March. That's when we made the mid-cycle transition call. The market has moved aggressively towards high quality, large cap, high quality in particular. And what the market is saying is that we're taking shelter. The market, it's got to own something, right? And what happens is people move to, the highest parts of the land away from the flood. And that's what the high quality stocks are. Typically, when you get to the point, the moment of truth, which is now, which is where the earnings start to get cut and where the Fed actually, moved to tighten, then even the high shelter areas are no longer protected. And that's how the mid-cycle transition ends. So, the script is really playing out to a T. It's hard to trade. There's a lot of cross currents, but generally speaking, we're right on schedule and it should finish up in the fourth quarter.
As you said, the rolling correction since March has left a lot of big stocks, like big tech stocks, down substantially. If we get a full 20% correction here, what will be the drivers of that, given how significant the correction's already been in some of the major components of the indexes?
Well, Lisa, but quite frankly, those stocks benefited tremendously from March until recently. So they had a huge move up, and that's what's held the averages up. So now they're going to have their comeuppance, and they may not even go back to where they were in March, and that would be a big drop. But they're going to have to go down if the major indices are going to have this 10 to 20% correction, and that should happen anyways, because quite frankly, those stocks are most vulnerable to a tightening of financial conditions. And not all of them, but I think several of those companies are also vulnerable to this payback in demand from the overconsumption during the work from home period.
So what's the driver then? Is it going to be just a direct yield correlation story that basically as yields go up, the big tech stocks sell off, or is there going to be an earnings component as well?
Yeah, I think it's both. I mean, that's the fire and ice, scenario, right? The fire is basically you get a tightening financial conditions, multiples come down, and then you get a little bit of ice on the back end of that. The deceleration that you always get at this stage of the economic cycle is normal. Now, normally what happens is, earnings continue to go up, but because the amplitude of this, recession recovery were so dramatic, you have to assume that the mid-cycle transition deceleration will be more or larger than average, okay? I mean, to think otherwise would just be intellectually dishonest.
Mike, are we finally at a point where we've been so wrong about single-digit actuarial assumption, 10-year SPX, 15.7% per year? Can you tell your team at Morgan Stanley the single-digit equity return world is finally upon us?
Yeah, I mean, look, it's interesting, Tom. I think you understand this, but it's easier to predict stock returns over a 7-year period than it is over a 1-year period. Why is that? Because over 7 years, the value, your starting valuation comes to fruition. Okay, you can't avoid that. Your returns, your actual returns over a 7-year period are contingent upon the price you pay. And we all know assets are expensive right now, whether you're talking about bonds, which are being financially repressed, or stocks, or any asset that's tied to the 10-year treasury yield, which is artificially low. So yeah, I mean, the starting point is poor on a 7-year basis. And so it's high conviction, and this is not a big call, by the way, high conviction. It's a single-digit return outlook, okay? Not the end of the world, but I mean, that's what financial repression is. I mean, that's the world we're in, lower returns. It's not the end of the world, but that's a fact.
Ooh, a fully loaded interview right there.
Yeah, and quite a logical interpretation of what's going on right now.
Mm-hmm.
So if you have the ability to sell on the strength, you might be good to hold some cash. So when we do have this correction, and again, the signs are there. You see signals,
right,
on the data.
So these are not just signals like drawings on the board. These are like qualitative signals, like economic, also as well backed up by that guy who's like very, intellectual, like an intellect in terms of stock market fundamentals. Like, it's better to be prepared. Mm-hmm.
Yeah, and you're right, and that's exactly what I'm trying to say. Stick with your plan. If you have planned for a correction on the market, then pull out some cash,
right?
So that you will be prepared and you have your emergency fund on hand,
right,
when that time happens.
Yeah, one
and
thing go ahead,
and
sorry.
like you mentioned, we had a bull run for the last 7 years, so why not take profit or realize your gains, since you've already earned it, right? And that's what I'm trying to remind people in the group. You could be euphoric, you could be emotional about your decisions, but don't forget to take profit when the strength is good.
Right. It's contrary, because these people do this investment advices or outlooks or opinions about the market as their professional line of work. So one is saying that there's still all-time highs in the horizon, which is Tom Lee, and he even sees like possibility that the profits will still increase for the big tech despite rising rates. Meanwhile, Morgan Stanley sees it like as overvalued, overly stretched, which is obviously the case. So that's their fire part of their fire and ice discussion about the stock market performance in the coming months and coming years. It's not going to be a great return, he said, but low returns definitely in the coming few years. So yeah, well, Wawi, thank you so much for coming on, listeners. I think well, before we leave, Wawi, do you have the quote of the week?
Yeah, well, I'm pulling from the book of I Ching. Okay, so that's what I was looking at earlier. I think it goes in line with what's going on here with the tug of war, in the market. Who's right, who's wrong, bull or bear.
Right.
It goes back to staying in the middle course.
Mm.
So in Chinese, the exact meaning of excess is going beyond the middle way. It violates the doctrine of the golden mean. Small exceeding is a time of transition. During transition, insufficiency is better than excess. Little affairs may be accomplished, but not great affairs. Okay, so this is just a reminder from King Wen in China, right? So when it's hard to make a decision, just stay in the middle way, be logical about it. If you have a plan in place, make sure you stick with it. It's always good to have a plan to stay logical in your reaction. And don't forget, a lot of the market corrections are man-made. A lot of our recessions in the market are man-made.
Being overly exuberant, of course, I think kind of like turns out once you're overly exuberant. Well, that kind of reminds me of our sentiment, Huawei. That's a really good quote because it's very timely. The neutral sentiment and the American Institute show that people are now, moving away from the end side of things, like being bullish and being bearish. They're jumping on the middle, staying neutral. So I think people are somewhat being cautious of the market, which is nothing bad about. What a timely quote, Huawei.
Yeah, that's a normal reaction. So don't be abnormal.
Don't be abnormal. All right. Well, Huawei, thank you so much for coming on this week. Again, we apologize for missing out last week to our listeners. For your questions, or if you just want to say hi, don't forget to submit your questions at markuhuaweishow@gmail.com. And remember, build that emergency savings and invest the rest for an abundant retirement. Again, this is Mark Yu signing out.
This is Huawei Santos. Hi to Philip Conde. Congratulations.
Congratulations. Bye.
Bye.